and we're drop quite a bit yesterday, and it appears continuing again today on Brent, just below $93 a barrel. The Despite what has to be said, lots of positive vibes out of China, if nothing else. A pretty solid handshake between the president of the US and the leader of China yesterday. Even a smile, I think I saw President Xi provide to the world, or at least some element of what looked like something positive. Let's go to China for some thoughts on this fairly, historic meeting yesterday, the first between the two leaders. Albert Stromquist, principal at Landstrom Advisors. The big meeting, Albert, within the context of a number of signals from China to reopen its economy. Your thoughts of the significance of developments over the last few days?
Well, look, the meeting obviously was quite positive. They're two very seasoned politicians, and politics, goes without saying, is performative. So there needs to be a good face on the public side of the meeting for the audiences at home and for the constituents. Now, there were good words spoken briefly by both President Biden and President Xi. The actual offside meeting on the sidelines after the television part was a bit more tense, I understand, from the reviews that I've read, with major contentious issues being trade and, of course, Taiwan. Now, there's been good words said about changes underway in China. Your question yesterday referenced the property sector regulations intended to save the property development sector and put it back on a solid footing. That remains to be seen how effective those steps are going to be. They're certainly going to prolong the agony rather than accelerate the recovery. Beyond that, there's no green shoots yet of a kind of restart of the Chinese economy. It remains mired in the doldrums. Manufacturing is down and continuing to decline. Consumer spending has declined. Consequently, any good news that might forebode an increase in energy demand in China it's not there yet. In 2023, based on what we see today and where we are today, looks like it's going to be more of the same rather than a step change over the current conditions.
Just to follow up a little bit on that, Albert, just from your own kind of expectation, does it feel like it's more than you had thought this quickly after the Communist Party summit or Congress Party meeting last month?
There are two messages coming from China. The summary of the party conference in October told a fairly different story. One of a passionate commitment to a regression to the 1950s and to an exercise of pure Marxism-Leninism and a reestablishment of statism and reinvigoration of state-owned enterprises, pushing back against the private sector and creating more of an economy that felt familiar 70 years ago. This is not surprising because this has always been President Xi's passion. He is a strong advocate of the legacy of Mao Zedong, and in many ways sees himself as the natural heir of that legacy. So it's a surprising development, and it remains to be seen how far it's going to go, because he does have members of the Politburo Standing Committee who are more market focused and have a commitment as well as an interest in the private sector. So the actual rate of change and degree of change is at this point hard to predict.
Let's go to Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Henning, I'm curious from your point of view what the optics of this meeting and handshake and just about smiles between Xi and Biden will have looked like from Moscow.
Well, from Moscow's point of view, of course, this is the biggest enemy and the biggest supporter talking directly, and President Putin isn't there talking directly. So it's awkward for Moscow because, Mr. Putin won't directly know what Mr. Xi and Mr. Biden have been talking about. And this is a really good example of why direct meetings in politics really work. Now, because from a US and Chinese point of view, there's very little leeway that they can give each other, and the general positions haven't changed a millimeter over the last 2 days. But the fact that they've talked, and apparently they talk constructively, and they both seem to be fairly happy with the meeting, is positive for them, both bilaterally, for the world. But for Russia, it must be a little bit awkward, because we'll now have to wait and see what the final declaration of the G20 comes up with, because I don't know, but it's entirely possible that they've agreed to say something about Russia. And Putin has no influence of talking, no influence on this conversation. So for Russia, this is an awkward situation to be in. And of course, Lavrov being there is not a replacement of Putin.
Just to follow up on that, Henning, would you note that there was some reference or some alignment around against nuclear weapons? The talk about nuclear weapons seemed to be something that they had agreement on, that they both actually articulated?
So we'll have to wait and see what the final statement comes up with, but it's pretty obvious that China doesn't like the idea of the use of nuclear weapons in the Ukraine war. We've seen that China's hinted at this before. Actually, they've said it. And also when German Chancellor Olaf Scholz was in China the other week, he came back with the same statement that Xi Jinping had told him that as well. So it's pretty obvious that China wouldn't like the use of a nuclear war escalation in Ukraine. So that pressure, that alone is a positive outcome, that China comes out in some form and to make this obvious.
Maliha Bengali, founder, MB Commodity Corner, coming to you last, Maliha, so hopefully you can make some market sense of what Albert and Henning have said, because I'm struggling to. We had some bearish and bullish remarks from Fed officials over the last few days. We've had positive COVID comments out of China and some not so in the last 24 hours. Where's the market going? It seems downward.
Thank you, Sean. So on the oil market, the big debate right now is on the demand side. Now, we all know about the oil tightness, but what people are failing to understand is the tightness has come from products, distillate and gasoline, the refining side, due to maintenance outages. We feel, we have a theory that China actually is buying that oil to actually produce more products and give it back to the market. Now, we're also going through a period of time where demand actually has been really soggy. So the big debate right now is how bad is demand in Q4? And we think demand actually is quite weak. So this is all being compensated by the seasonal strength and the heating oil issues, but the market is sort of balancing itself out, and oil is just an input for an output that is sort of settling out. And we know about Russian oil. Russian oil is finding its way to the UAE right now, India, and it's being processed, it's being spit back out. So we need to look at all these oil flows, but taking a step back, China is really not opening up fully. And I totally agree with Albert that they're looking at pockets of strength and supporting the market, but the bigger picture is they cannot stimulate their way out right now. It's a bit too early.
They did a pretty big announcement. I thought to myself when I heard it, this is actually bearish rather than bullish. The real estate property announcement the other day, which seemed to be of such a scale that it actually was like, oh, this is bigger than I even thought this was. It was kind of.
It does help, but then take a look at the US and European markets. So the big export market for China, look at shipping rates and freight rates. It's a lot of weakness in developed markets right now. So yes, there's a bit of strength there, but net, the global credit impulse, we are going to negative territories. Taking a step back on the Fed. Now the Fed, obviously, the market has been positioned very long dollar, very soft bearish bonds. So the glimmer of hope on the soft CPI number just caused books to massively unwind their position. This is more of a financial unwind into November and for a lot of hedge funds, and people got caught on the wrong foot. Now, the Fed may slow the rate of tightening, but they're not easing in any way. This is not a pivot. Going from 75 to 50 basis points is still a tightening mode. We go back to 2001 when the Fed did exactly the same thing and markets fell more. So I think you need to take a step back from the financial unwind and from the physical data, but the markets are very volatile and people are all sided in one direction. And I think that's what's causing a lot of volatility.
Albert, your thoughts on the actions that the Chinese government has announced in recent days, particularly on the real estate side, that softening of lending, the sort of facilitating mortgages even on a retail level, not unlike a lot of the generous offerings that were made to the US market 10 plus years ago?
The step that is likely to make the biggest difference is the softening of the equity required for a home purchase. Right? The problem that China faced, or manifold, but one of them, you've encountered the phrase "common prosperity." I'm sure in your readings on China. Okay, this is another way of stating an old, famous Marxism parable. To each according to his need, from each according to his ability. So there is an implicit threat against the high net worth and high income Chinese to expect a seizure of assets of some form, a Robin Hood move to shift funds from their pockets into the pockets of the less entitled in China. All in the process of equalizing population, but more so creating a consumer economy. That leaves people very hesitant about major purchases, particularly home purchases. So yeah, the developers may look a little bit better with their balance sheets improved by the revised payment terms and payment and deadlines and all, but the fact that there's still not much demand in the marketplace for homes today, and that's not likely to improve quickly. So there's a lot of inventory left in the market, languishing. That needs to be purchased if it's going to make a difference to China's economy.
There was a data point shared yesterday or earlier in the week that it's something in the range of 90 million vacant apartments in, I was going to say in Dubai, but it's not quite that many in Dubai, but in China, which of course is just a huge number. Henning, let's talk a little bit about all things Ukraine and the sort of outlook there. We had some words from the President Zelensky this week. I think he even phrased it as the beginning of the end with the retaking of the capital city or the major city in the east, Kherson. What is your thoughts on that kind of language, that kind of sort of energy, if you like, around the status quo at the moment in the Russian invasion of Ukraine?
I mean, it's a huge achievement, liberate Kherson. It's and it's a huge blow for Russia. It's the only capital of any significant region that Russia had managed to invade and conquer, and now it's gone. And it's the capital of a province that Russia has illegally annexed. So it's a huge achievement. But we don't sadly see an end to this conflict this winter. It might get frozen or stuck in the mud, literally, but at this stage, I mean, the Russian forces, because of the river that they retreated over, are in a much better position to defend. It's all military experts who we talk to say this is this is going to probably fix or freeze the conflict in its current situation. But freezing conflict also doesn't mean that there is no fighting. It just means that the front lines might not move as fast as they have been over the past few months, and it could still get very nasty. I mean, and also, I mean, if we see the first reports coming out of Kherson, again, sort of total destruction of infrastructure, thousands of people missing, civilians missing, it's pretty nasty, sadly. And I mean that the Ukrainians are lifted by liberation of this major city is understandable, and it's a great achievement. But sadly, it's we're nowhere near, we think, of any form of an end to this war.
That's not good news. Maliha, I'd like to get your thoughts a little bit on where the dollar's at. I think it's sort of, in some ways, it was the sort of guiding story of the last month or two or more, reaching high peaks not seen for many years, particularly on the yen, but also the euro below par. Lots of people were calling the sterling below par, but the sterling's come back quite strongly. Where do you think the dollar's at? Has it peaked already? Could we see another peak?
You're right. So the dollar has had a massive uptrend all of this year. But if you take a look at the charts right now, we've just reversed from very overbought conditions down to the 100-day moving average. So the big question here is, does it sort of keep its uptrend? We feel the dollar will still stay stronger because if you take a look at versus the euro or the sterling, the Fed is still tightening a lot more relatively aggressively. And I think it's the rate of change. It's not about 75 or 50 basis points. The Fed's in tightening mode. And until inflation comes down to even 3 or 4%, they will not hold off. So once we see that relative balance shift, we do not see dollar sort of giving back its gains. So this would be a restart of the uptrend into the end of the year and next year. This is more of a financial unwind because, like I said, people are caught on the wrong side from a Fed pivot. December FOMC is a very important time for the Fed to, sort of reassess and sort of clarify his assumptions, because obviously he was very hawkish in the press statement, and all these comments in the market afterwards would mean that the financial conditions have eased, and the Fed does not want the financial conditions easing, which means they have more work to do. So we are still in the dollar bullish camp for sure.
And on that sort of the sterling bullish run at the moment does seem to be on the back of the expectation of the autumn budget statement, the sort of final piece of recovering from the mess of the short truss era. What's the expectation there? Is the market over optimistic, or what are your thoughts on that?
We feel a bit over optimistic. I don't think sterling is driving that cross rate. I think it's the dollar driving all the cross rates more than the sterling story per se. So I think it's important to keep in mind what the Fed is saying and all the comments coming out, because in the bigger picture, we think that's driving a lot more than sterling specific issues. But yes, I would say over optimistic.
Albert, looking at the Chinese outlook into the new year now, vis-a-vis this sort of opening recovery, the sort of commitment recently to allow more product exports into by the independents into Asia. Where do you think oil demand goes into the new year? Can OPEC Plus, as it sits down in a few weeks, expect that China's coming back in 23?
No, I think I mentioned earlier here in the webinar, I don't see any dynamics here that would support a forecast of stronger energy demand, oil demand in China going into the new year, right? Look, there are still travel.
I mean, it's typically a higher demand window normally going into the last quarter ahead of the Chinese New Year. That seasonality, will we at least get that, do you think?
Well, look, the government has expressly cautioned Chinese to stay home for the Chinese New Year, right? So that puts a big damper on spending right there, right? It's very hard today to move around internally in China, not even for foreigners, but Chinese as well. It's very dangerous. So there isn't a lot of movement here inside the country. And there's no movement across the borders. So the people are pessimistic. Right.
When you say it's dangerous, what do you mean dangerous? Just from the health?
The snap lockdowns. Everybody's pretty healthy, but the snap lockdowns are cruel and brutal, right? And nobody really wants to expose themselves to a risk of being caught in a snap lockdown away from their home, right? So they stay close to home, right? And this changes. It can change in minutes or hours. So there's no prediction around that. And the zero tolerance policy is kind of a core part of the president's program going forward. He's loosened a bit. He and his team have loosened a few regulations, but it amounts to a change in mascara more than it does a major policy shift.
Let's go to the survey question and get a view from the room on the sort of summit yesterday. How significant was it? Will the China-US summit ease tensions between the world's two biggest economies in 2023? I mean, we were only a few weeks or maybe months ago now, but not so long ago, Nancy Pelosi visiting Taiwan. There was a blockade of the island. Everything was looking incredibly tense. Now, after this meeting, at the very least, have we stepped back from this kind of sharp edge? Will China-US summit ease tensions between the world's two biggest economies for 2023? Yes or no? Henning, I wanted to get your thoughts on COP27. Of course, it's a big summit. It's coming into its last few days. Do we have any expectations of some significant? Last year, we came out of COP26 in Glasgow with energy transition, massive wind in its sails. On this occasion, everything feels a little bit, less.
Yeah, sadly, I think you're right there. And I think there's a problem. You said it there. So last year there's quite a lot of big announcement, and it's only a year ago. So you can't expect another range of big announcement just for the sake of it now. On top of that, of course, the world has been distracted is the wrong term. It's been, the war in Ukraine has sapped energy literally out of most economies, and they've got different things to worry about. So you can't really blame COP27 in Egypt for not producing grand results at this stage. And you never know, maybe they come up with something normally the second week is more important, and we're in that now. But our expectations are fairly low. We would put more expectations into next year's COP28 in the UAE. But that's not to discredit this one now. And I mentioned it earlier, talking is always good. I know COP gets some criticism for talking too much and doing too little, but the fact that people are meeting and talking, I have to stress, I think is a positive development. And it's in Africa. There's a slightly different sense to it than being in a G7 nation as last year. So better it's happened that it's not happening is my view.
Malia, the tangible factors related to the economic slowdown that we've been hearing a lot over the last number of months, and some fairly draconian outlooks by, even the leaders of the world's biggest investments banks, Jamie Dimon using some language a few months ago that, had one storing canned beans in your basement. But that does not seem to be transpiring. Yes, we've had some announcements. And are they big? Amazon, 10,000 employees. I think they employ over 1 million people, are letting go. They're the latest. We had Metaverse or Facebook announce last week. We had the UK announce a 0.2% contraction of its economy. They're bad news headlines, but they don't seem anything to get too concerned about. What are your reading of these tea leaves?
So this is going to be very interesting for Q1 23. Next year, the Fed, as you said, always plays a reactionary role. They don't preempt, they only react. So they need to start seeing this data, and the data on the payroll side will start getting very negative into the next year. And once they start seeing unemployment rates shoot up, which they will, because the Q3 conference calls across the board have seen massive tech layoffs, but the Fed can't do anything until it sees those numbers. So yes, once we start seeing the data next year, we think first half 2023 will be very ugly, which is why economically speaking, we'll be at a time where the Fed is raising rates. The economic data is very weak, and that's when the Fed, if at all, might pivot, but it's not there yet. So we are quite bearish on that economic data going into Q1 next year.
Albert, the headlines on Reuters today a little bit sort of caught me by a surprise that Chinese refiners would be slowing down their Russian crude oil purchases because of the arriving sanctions in December and this whole idea of the oil price cap. Does that seem aligned with your thinking or your views where China's going, that the amount of discounted Russian oil may slow down into China, which has been, of course, quite significant this year?
Well, no, actually, the statement confused me because it seemed more like a statement that was created for public consumption. To avoid saying what they really believed. Why are Chinese refiners slowing down import of any crude oil? Lack of demand is one, right? They were exporting product in batches for foreign earnings, for foreign revenues, but that hasn't been consistent either. So I think what you're seeing from this is kind of a statement of the general malaise of the Chinese economy today, rather than a deliberate strategy based on a single variable.
I mean, they have been sensitive in the past to sort of, while politically announcing, dismissing extraterritorial sanctions, but they have on a micro level, on the independent refinery level and elsewhere, somewhat sensitive not to be caught on the wrong side of international sanctions, U.S. sanctions.
Well, that's true. They say, yeah, they oppose sanctions, but they are very sensitive to that as a bilateral issue between China and the U.S. and China and Europe as well, of observing sanctions and respecting them to maintain a stable marketplace, I suppose, for them. So yeah, go ahead.
Go ahead. I was just going to say, Henning, just looking at that point, where do you think we're going now with only a few weeks ahead of this European decision? How big will it be? It sort of feels like a lot of noise on the build-up, but the delivery might be a bit of a damn squid.
Well, also directly following up to what was just said, Chinese state-owned oil firms often trade out of Singapore, and Singapore has imposed sanctions, and that has affected their action a little bit. Overall, so we still think that the imposition of the Western phase-out and then the price cap via the maritime insurance ban will disrupt the market quite a bit, in the sense of, first of all, Europe has to stop its shipped imports from Russia, especially of Urals crude from the Black Sea. Italy, in particular, they've been front-loading a lot of oil from Russia into Italy, still going in. So that'll have to stop. It'll be sapped up elsewhere. Maliha just mentioned cargoes just have gone to the UAE and being processed there. The Chinese might underwrite some shipments themselves. It's national companies, so the government can underwrite their own national tankers. So the big one I'd look at is India, because India doesn't have its own fleet. They don't have their own insurance market. They rely on third-party merchants. We'll have to wait and see how that happens. Overall, I actually think, though, there is probably enough crude oil in the market to meet current consumption, current demand levels, because as we've just heard, it's pretty weak anyway. So if there are major, there'll be a dislocation in price and it'll probably bump up, but the full-on disruption we think is going to be fairly limited while the demand situation is so weak.
And the stress in Europe, the energy crisis, should we stop using that word?
No, I wouldn't stop using it right yet, but the super mild weather in October, November so far has really helped. Industrial consumption is also down by a third in Northwest Europe, so far without a loss of output, which was remarkable. And of course, the supply side of alternative supply has worked very well. LNG from the US, pipeline from Norway. Mozambique has just delivered its first LNG cargo on time, on schedule. It's going to Europe. So far, so good. It looks much better than we thought it would.
Energy consumption in Northern Europe is down a third, and industrial production hasn't changed?
Indeed, yes. So far, so the figures are out. Yes, they have invested into efficiency gains.
That means it's good. One should buy some equities in the German DAX. There's going to be very profitable German companies if they're saving that kind of money. Maybe the other 70% of the energy they are consuming perhaps is at double or triple the price it was last year.
Well, exactly. So we are still expecting a recession. Don't get me wrong here. It's recessionary, but the efforts made, especially by industry, to reduce consumption are remarkable. So it's worked. We're cautiously optimistic about this winter, and we got lucky.
Leah, let's give you the last word with the survey result. Yes, will China ease tensions for the two biggest economies into the new year? Looking at where the direction of travel goes on rates and its impact on all financial markets, it seemed like we had a lot of voices from the Fed over the last few days trying to clean up the mess. There seemed to have been suddenly the markets and the Fed kind of lost their journey together. They were holding hands, kumbaya, dancing in the same direction. Now it feels like they've kind of disconnected. Your thoughts on that thesis, and what will bring it back together, or will it come back together?
So we did a very simple analysis. If you assume core CPI stabilizes around 0.3% month on month and stabilizes here, it will really get to 4% by the end of next year. So assuming that inflation stabilizes here and falls slightly, we're still nowhere near the Fed 2% target. So thinking about that for a second, everything needs to fall a lot more for inflation to really come down. So the Fed will slow the rate of tightening, but they're not pivoting. They're not stopping in any way, because as the market holds up here, the Fed has all the ammunition to keep going.
So and I think Jay Powell was pretty clear about that at his press conference 2 weeks ago. The market seemed to forget that very quickly.
Absolutely right. And obviously with the big move in the dollar, the yuan, the yen, gold, silver, this was a massive financial unwind. You cannot discount how November plays a very important role, and people have been very one-sided and they got caught out. So over the next few weeks, you'll see how these trends will stabilize. But no, the Fed is not close to pivoting. They will ease it down. They have to obviously see how these rates have impacted the system. But economically speaking, inflation is high and growth is slowing and markets are still holding up. So why should the Fed stop right now until they see some proper damage?
Yeah, I think they will be the most sensitive to where jobs numbers go, and if the jobs hold up, or at least ease not dramatically, I think they'll keep going. But I think they will be very, very sensitive to what is a very tight labor market because of the Great Resignation. There just isn't the labor there. Brent crude trading at 92.80, down a little bit after yesterday's decline. OPEC Plus, we didn't talk about it all, but I know they're incredibly sensitive to that $90 Brent marker. If we do approach it over the next 2 weeks ahead of the big OPEC meeting, we could be seeing yet another cut into the new year, and that would probably be quite dramatic given where Russia's going as well. So we'll have to wait and see and watch that closely. But as always, thank you so much, Albert Stromquist from China. Great to get your views. Malia Bengali, as always, thank you. And Henning Glostein, thank you very much for joining us today. 10:30 every day UAE time. We're here just taking a quick pulse of the markets, and we appreciate your time and insights. All the best.
Thank you. Bye-bye.
Thanks.
Thank you.